Hi, I'm Tom Lydon with ETF Trends here in Chicago at the Morningstar Investment Conference, here with Dan Draper, who's Managing Director, Global Head of ETFs at Invesco. Great to see you.
Tom, great to see you. Thanks for having me.
We got a lot to talk about. We're going to dive right into fixed income. We've had a lot of discussions about rising rate environment and what that can do to a fixed income portfolio. You folks have the BulletShares under Powershares Invesco. Tell us a little bit about how they work and how advisors use them.
Yeah, no, this is exciting. As you know, we purchased the BulletShares range and the rest of the ETF business from Guggenheim. We closed the transaction earlier this year, and I think, look, BulletShares is definitely one of the most important, I think, areas that we brought over. And to take the open-ended nature of an ETF, like a mutual fund, but then to actually have a final maturity date, kind of that certainty of kind of principal return, that's really, really important for many investors. And you mentioned, crucially, in a rising rate environment. Being able to now build laddered portfolios, and again, being able to, if you will, refinance, invest at higher rates of return as rates go up, it's an important innovation.
So for example, if you have a corporate bond that matures, a portfolio matures in 2020, at the end of that period of time, the bonds that are all dated 2020 mature.
That's right.
And then you basically give the proceeds back to the shareholders.
That's right. And at the same time, we're going to be offering newer maturities coming out along the way as well. So effectively giving investors the opportunity to refinance, if you will, at, again, higher rates if rates are going higher.
So the whole idea is if during rising rates, if you are affected by that at all, it's because you're selling it before they mature, but in this case, you're not, because they just expire at that maturity.
That's right. But still enjoying, the open-ended nature, before maturity, where the funds are not only trading at net asset value daily, but on an intraday basis as well. So you're getting the best of an ETF, but at the same time, from a risk and a portfolio management perspective, getting that final maturity and the laddering opportunity if you're buying a series of these.
You do a lot of studies among advisors and institutions with treasuries being most affected, especially long treasuries, by rising rates. Are you seeing that advisors are maybe stepping out of the Barclays Ag to some degree and customizing their fixed income portfolios a little more?
I do. I think the US Ag that you mentioned, which is kind of the big benchmark, if you've kind of bought and held it over several years now, you wake up in a rising rate environment and say, well, I have now a product that has over a 6-year duration, and all of a sudden I have more than 70% exposure to treasuries. And that's kind of, and again, thinking about that from a diversification perspective, those may not have been intended consequences a couple of years ago when you were initially buying the product. So now coming in, how can I diversify different maturities? Well, that could be BulletShares, or can I diversify maybe other areas of credit where I may receive a better risk-reward trade-off? So saying all those characteristics give you an ability to, I think, relook at the portfolio. And I think, when we touched, the 10-year Treasury over 3%, last month, that really, I think, woke up a lot of people. Are you properly diversified? And the answer was no. Look, this is our job. We want to really bring as many products as we can to market to help in that discussion.
Low cost, pure beta, cap-weighted indices work really well while they're working well.
That's right, that's right.
But when they don't, they don't. And after 30 years in a bull market in bonds,
that's right.
Maybe this is the time to do your own deconstruction?
It is. I think so. I think just diversification is the name of the game now, right?
Yeah, absolutely.
Across asset classes.
As always, Dan, great seeing you. Thanks.
Thank you, Tom.
Thank you.